right, welcome to Money Business with Brian Weyman.
Neal Regino.
Today we are going to be talking about succession planning. We're going to get into key man insurance, things along those lines for the business owners. And where do you want to start?
I actually think starting with buy-sell agreements. So this is something that we ask every business owners. What's your plan? If something happens to you, what's the contingency plan? Everybody has an operation agreement in place if they have a business partner. Not many people have a buy-sell agreement. And even if they have that in place, they don't actually know how they're paying for it. So just a quick story about somebody that was a personal contact of mine. A friend of mine that I went to school with started a landscaping company with him and another partner. It was pretty successful. They were doing over 7 figures a year, had a number of employees, and at 30 years old, his business partner had a heart attack on the job and passed away, unfortunately. He has a wife, so they didn't have a buy-sell agreement in place. The wife now owns 50% of the business. She collects his salary. She will get 50% of the business if they ever sell. And rightfully so. She should be compensated, but she's not involved in the operations whatsoever.
Does she get along with the partner?
They do,
Okay,
yes.
well,
And
at least there's that.
and they had a good relationship. He wants to take care of his partner's family. However, it's an unfortunate situation, but it could have been avoided. And what people don't think about is if something happens to me, whatever percentage ownership I have goes to my next of kin unless this is in place. So a buy-sell agreement actually stipulates if something happens to one of us, this is exactly what's going to happen to my share of the business. And typically it's that other owners have the right to purchase them out. And what we do, a big part of this agreement is we put insurance in place to say, okay, if something happens to the business owner, the insurance policy pays out, and that buys the family out of their share, at least for a portion of it, if not all of it. When you do that, there's also ways to set that up correctly. For smaller companies, we do something called a cross-purchase agreement where each owner owns a policy on another owner. They're paid out the benefit, and then they buy out the family, and that actually increases your cost basis. So if you go to sell the business later, it's less of a tax liability than if the money paid directly out to the family or paid to the business and then paid out to the family. So that's really important. But another part that's important is what happens if the other partners or owners become disabled in some way and they can't actually function day to day in the business, but they still own the business. Well, does it make sense then to add something called buy-sell disability insurance? And what that does is replaces revenue, whether it's income or business overhead, to actually replace the lost revenue that's being brought in by that owner in order to find a replacement during that time. But it helps to not burden the business with an extra cash flow that's not being replaced by revenue.
Right, and that's probably only going to that's only going to come into play, I guess, if it's somebody that doesn't produce in the day to day of the business, it's not really going to matter.
Yep.
If they're just a silent owner, or
Yep.
they can do what they do from anywhere, it may not be an issue. But if they're in the day to day, to me that could be worse than dying.
Yeah, and it's actually more than likely that that's going to happen than
Higher percentages.
higher percentage than that they're actually going to pass away during the life of the business. So that's something that's important to explore, is having that arrangement in place, even if it's not backed by insurance, and it could be a combination of a payout and a draw, but also if it is a payout and you're not using insurance, how are you building that asset up so that you don't have to take a loan out or have to take money away from the cash flow of the company in order to deal with the uncertainty. So worth exploring that conversation.
Well, what I was going to say now, so that's how it goes with your partner, but what about that key employee?
Yep. So while you're building a business, the key is to attract the right talent that's going to really grow it. Obviously, you need your rank and file, your day-to-day employees that are doing the daily activity, but the leadership is where you're looking at what's important. So one thing to consider, there was Netflix, when they were building their organization, decided we don't need hundreds of engineers to build out our platform. We need the best, and we need to pay them a lot of money. And so they were able to find one person and then a bunch of rank and files under that person that actually built out their entire online platform for streaming. And if you find that person, whether you went out and acquired them or they became that person, well, first of all, you have to think, how much revenue does this person account for? If they weren't working anymore, what would happen to the business? And so those are your key people. And so when you have the key people, there's a lot of things to think about, but do you want key man insurance that covers them in case of death or disability? And protecting that key employee is protecting your business. So a lot of people think, oh, this person, I can't live without them. They're doing a lot for the business, or it would be really hard to replace them. Well, what are you doing to protect yourself against a loss? Yeah, it could even be for them quitting. How do you protect against that?
Right.
So,
Right.
so the key man policy, if you do a life insurance and something happens to them, unfortunately, then that pays out to the company, and then you can decide if their next of kin gets anything, but it at least will come back into the business, so it replaces that loss of revenue. Or disability, where it's replacing so that you can still take care of them and not have to burden the business. So that's really important.
So I'll give you a backstory of a kind of a twisted both ways to look at it. I don't want to say twisted, but a sole prop with an assistant, and the owner of the business was also obviously the key man, right? So the scenario was that she had worked in her industry and she did a very transactional type of job, and she had an assistant, and they only got paid when they performed their duties on each one of these jobs that came up. And the idea really was, well, what happened is she ends up getting sick with a cancer. And her insurance had the living benefits built in, that some of these living benefits. And for those of you that don't know, living benefits are life insurance policies have riders built into them for heart attacks, cancer, stroke, long-term care, a whole bunch of things. But she got a cancer. She was out of business now for 6 months. But she didn't want to lose her employee.
Yeah.
So the business has to stay up. So she's the key person trying to hang on to an employee because she had trained this employee for years. And the business was going great. But if she's out of the picture and there's no business to be done, the employee can't get paid without her. So even though she had enough savings and put away that she didn't need to tap into the insurance, the key man insurance actually on her gave her enough money to keep her employee afloat until she came back in and business resumed as usual.
That's
so
right.
There's all different ways to look at whether it's key man, buy, sell. I think more and more you talk to business owners, you start to give them these stories of the things you see that happens, and they just can't wrap their head. Like no one thinks these things are going to happen to them, but at the end of the day, it happens.
Yeah.
It happens. It can happen very easily. But let's real quick on the key man part. You mentioned, what if the employee quits? Let's talk real quick about golden handcuffs.
Yep. Well, so first of all, when you have somebody that you really want to grow with and want to keep, I have many clients that have said, how do I keep these people here? Executive bonus plans is one way, which golden handcuffs is one of those. Most owners in general don't want to give up equity to the employee. So what else can you do? Executive bonus plans are one. Phantom stock option is another type of executive bonus where they're actually growing with the business but not getting equity in the actual company if there's a sale, where they have basically shares of the company that are phantom stock. They're not actually ownership, and they're marked to the growth of the company every year. So that there's ways to build a pool there. The golden handcuff says there's money being allocated to the employee that they vest in over a certain period of time. Can be with that there's less regulation. It could be 5 years, it could be 10 years. It depends on how you have everything set up. And then, publicly traded companies offer stock options that you vest in as well. It's a similar type, but they're deferred compensation arrangements. Um, there's a lot of things that you can do on that side to incentivize them, but then you have to weigh, well, what's it worth for me? What are the tax benefits for each one? How does it affect my ability to invest back in the business? But if that person's really important, there's a lot to do. The other thing I just want to say from a qualitative standpoint, what happens a lot of times when a business has a lot of success is you started with an employee that was really valuable, but then the business starts to outgrow that employee. And I've seen business owners that get frustrated with somebody that they relied on as a manager, and now they need them more in an executive role, and they're not equipped for it. Well, you can fix that. And that takes a little bit of time and energy and investment to say, well, let's bring in a business consultant. Let's send them to a training program. How do I invest in that person that's been loyal to me, that's not going to be a detriment to the company as we grow beyond what their scope of ability is? And it's just something that I think all business owners should start thinking about. That's not usually top of mind when I bring it up. When you see somebody go from $1 million in revenue to $100 million in revenue, and they went from 5 employees to 300 employees, and now that one person that was there when they first started is being lost in the crowd. And you have to think about it yourself as a business owner. How do I invest in my talent to make sure that they can grow the company ultimately, and it's going to help them as well? And those employees that grow with you and they see that you're investing in them, they're not going to leave you. So you need to create a place that they have the ability to leave and never want to. And that's how we build our organization. And I think every business owner needs to do the same thing.
Right, because not to downplay an employee, but sometimes that key employee is like a domino, and
Yep.
everything comes falling down. Well, I think that's good. That's great information. I guess we're out of time, close to out of time.
Yep.
I think that's all we need to talk about that. So thank you very much. We hope this was helpful. And I'm Brian Weyman.
Neal Regino.
And talk to you again soon.